How's it going today, guys? So what we're going to be talking about today is investing in real estate for complete beginners. Now before I get into the video, I just wanted to mention I've been messing around with my camera settings yet again. I know I had a couple of videos that were kind of dim because I didn't have my brightness adjusted the right way. So I think this is good, and if it's not, make sure you guys let me know, but this should be good. I did some trial clips with it and looked at it, and this seemed to be a good brightness that worked, so let me know how that looks on your end. Anyways, just to give you guys an overview on what we're going to talk about in this video, because it will be quite long, I think. I just wanted to point out what we're going to be talking about in case this isn't what you're looking for. I don't want to waste your time here. But we're going to talk about, first of all, direct ownership. And within that, we're going to talk about people who buy and hold real estate, as well as buy and flip. Then we're going to talk about real estate investment groups, then real estate limited partnerships, and then real estate investment trusts and real estate mutual funds, which kind of are similar, so I'm tying those in under the same group there. But the first thing we're going to talk about is direct ownership with the buy and hold strategy. So direct real estate investment has the highest potential risk and the highest potential reward. Obviously that's because you're buying that piece of real estate yourself, you're responsible for making those mortgage payments, and if you can't get a tenant in there to rent that property to, you're responsible for making that mortgage payment. Direct real estate ownership is not a passive investment. A lot of people try to sell real estate as a passive income source, and at first it's anything but passive, because anytime you need to make repairs, anytime toilets get clogged, light bulbs need to be changed, things like that, you're going to be getting phone calls from your tenants, and you're either going to have to call somebody to go make those repairs, or if you're handy, you're going to have to go make those repairs yourself. So if you're not somebody who wants those late night phone calls about toilets being clogged or furnaces being broken or whatever, maybe real estate direct ownership is not for you. The thing is though, real estate, even with direct ownership, can become passive once you have enough properties, because at that point it's cost effective to bring on a property manager. But if you're on your first unit or your first couple of units, it's probably not cost effective yet to have property management. So you'll be managing those properties yourself, as well as getting tenants in there and renting out the property itself. So you do have to consider that when you're investing in real estate and you're owning the property itself. You're responsible for all of that. So at first, it's definitely not a passive income source. The best strategy for a complete beginner, if you're looking to get into this method of real estate investing, would be the owner-occupant method, which is basically where you would live. You'd basically buy a multifamily building, maybe a 2-family or even a 3 or 4-family building. You would live in one of the apartments and rent out the others. The advantage to that is anytime that you need to make repairs, you're already there. And instead of getting that phone call, maybe they'll just knock on your door, you just have to run upstairs and change out light bulbs or whatever it is you have to do. Maybe you're lucky and you'll have good tenants who are willing to maintain the property and treat it well, but in most cases, just with talking to people who do this, a lot of tenants will not treat that place that they're renting the way they would treat their own home, and they may not be willing to do things like changing light bulbs or unclogging toilets or fixing leaks in the drains, things like that. So you're going to be responsible most likely for all of those things. But basically, here's how a direct ownership works. A person buys a property and rents it out to a tenant. The tenant pays the landlord rent each month, and then the landlord pays the taxes on the property, the mortgage, and the maintenance with the rent money. Now there's 3 common scenarios with this. The best case scenario is where the landlord has a cash surplus each month. At that point you have money left over that you can set aside for foreseeable repairs in the future. One of the biggest ones is if, let's say, you need to put a new roof on the house. That's going to be a lot of money, so you should start saving money for that in the beginning. The common scenario though is where there's no money left each month and you're just getting the free equity because basically they're paying the mortgage for you. So long term, that's going to be a great investment because once that mortgage is paid off, you own that property free and clear. And if you decide to sell it at that point, you get whatever it sells for. Or if you continue to rent it from that point forward, you don't have to worry about making that mortgage payment because you've paid off that property. And the best thing with that is you didn't even pay for it. Your tenants paid for it. Now the worst case scenario, which unfortunately is common as well, is that your expenses exceed your mortgage and the landlord will pay the difference because you're responsible for that mortgage payment at the end of the day and you're going to be having to make it regardless of the scenario. Maybe you're unable to rent it for a number of years or a number of weeks or a number of months, or maybe there's a lot of repairs that need to be done because you've had bad tenants. Unfortunately, you're responsible for that when you're the direct owner of that piece of real estate. And like I said, once the mortgage is paid off, you own the property free and clear. And at that point, you can continue to rent it and keep that cash surplus, or you can sell the property, get your money out of it, and get all of that equity out of it. If the property value appreciates while you own it, the landlord has a more valuable asset when they sell it. That's why one of the most important things when looking at a piece of real estate is the location. You want to make sure you're buying a house in a good area where the housing market is doing good, and hopefully the value of that house will go up over time. Naturally, house prices have gone up, obviously, except for the 2008 crash. Housing prices really suffered there. But other than that, if you look at the trends, house prices have generally gone up. So they are a good investment as long as you pick a house in a good area. So like I said, at that point, once you basically own that piece of real estate, your surplus is just whatever the rent is minus the taxes and the expenses on that property. You don't have to worry about that mortgage at that point. Now, if the, the property value, if that appreciates, like we said, it's a more valuable asset for you. And the most important factors when looking at a piece of real estate, there's a lot of factors. In fact, there's like 10 common ones. And I'll probably do a video on that in the future, the best factors as far as what you're looking at when investing in a piece of real estate. But the two most important factors are definitely the location of the property as well as the rental rates. So you want to make sure you're in a good location where the property value is going to appreciate, and you want to make sure that you're in an area where a lot of people are looking to rent, so there's a high demand for properties. That way you get more for rent, and hopefully you can end up in this best case scenario where you have a cash surplus each month. Now, bad tenants can turn your investment upside down, resulting in negative cash flow. This is very common because maybe they're bad on the property and they're causing a lot of damage, and you have to paint every time you change tenants. And actually, some states it's a law where if there's a tenant in there for longer than a certain duration of time, you're required to paint. So you want to make sure you consider all these things before investing in this. It's a lot more complicated than people think it is. So you want to make sure you understand what all of the laws are surrounding being a tenant or being a landlord in your state or wherever it is that you live. And then, like we said, property management is expensive, but it may become cost effective once you own multiple units, because at that point, you can have that one property manager represent all of your properties, and they should be able to give you a better rate because you're offering them more business at that point. Something else you have to consider as well is landscaping and lawn care and snow removal. Those are all things you have to consider. It may be the case where you have a deal with your tenants where if they take care of that, you knock some money off the rent, or you just have to contract that out, or you end up just doing it yourself if you're looking to put your own sweat equity into your property and do all the work yourself. If you don't mind going over there and mowing the lawns and shoveling the sidewalks and plowing out the driveway, then that means there's going to be more money in your pockets at the end of the day. Next, we have the direct ownership buy and flip strategy for investing in real estate. This is basically real estate traders who buy a property for a short-term hold. There's two types of these people generally that you see out there. One I think is more common than the other. But type number one, these are the people that make improvements and upgrades on the property, add sweat equity to the investment by either doing the work themselves or contracting out the work. And then but the problem with this is it's a time-intensive investment, and typically people who are doing this type of investment are only able to do one property at a time, unless they have a number of people working underneath them. Now, the second type of person who does a buy and flip type strategy is somebody who does not make improvements, but they're investing based solely on the intrinsic value of the property. What that basically means is they're hoping that if they hold that property for a short duration of time, they'll be able to sell it for a higher price because the market value is not representing what the property itself is really worth. So they're buying properties that they feel are undervalued, and they're hoping that in a short-term period, they'll be able to sell that property for a higher value without having to make any improvements. Now, I'm sure if you guys watch like those HGTV specials, you'll see like the house flippers. That's exactly what that is, that type one right there. People who buy properties, make upgrades and improvements, and hopefully sell it for a profit. Now, there's one problem with this, and that is that flippers often do not have enough to cover months of mortgage payments, which can get them into trouble. So let's say you were fixing up a property and you ended up way over your head, and you had a lot more work than you expected, and you set aside enough money for 3 months of mortgage payments, and next thing you know, you have to have that house for 6 months and fix it up during that duration of time. That might be a problem if you don't have enough saved up for those mortgage payments. So that's where some people get into trouble. I feel like the second type is even more dangerous, because if you bought a property because you felt it was undervalued and it ended up that it was fairly valued and you couldn't sell it for any more, or worst case scenario, you had to sell that property for less, you could be taking that loss, and that can be dangerous for you, especially if you don't have the money to cover that loss. Now, the third type is a real estate investment group. This is where you can own properties without the hassle of being a landlord. Basically, how this works is a company will either build or buy apartment buildings, and then investors buy one or more units through the company. Basically, the company then manages the units in the property for a percentage of the rent in return. So this is good for people who don't want the hassle of being a landlord. If you don't want those phone calls at night, if you don't want to worry about renting out the apartments or dealing with anything like that, you might want to consider a real estate investment group. Now, the best strategy for a real estate investment group is where all the owners pool a portion of the rent to protect against vacancies. So if somebody who owns units has a vacancy for a prolonged period of time, they still get their mortgage payments paid out of that pool of money collected from the other people who are owners of units within that building. There may be some that don't have this strategy in place, so if there was a vacancy for a period of time, you're still responsible for that mortgage payment on your own. So there's a good side to this and there's a bad side to this. The good side to this is that it's a much safer way to get into real estate because you have the protection of against the vacancies. If you do have rent collected in a pool, you also have somebody else managing those properties. But the bad side of this is it's typically a very high fee investment because the companies that own and manage these take a large percentage of the rent. So you're not going to make as much money as you would if you were a direct owner of that piece of real estate. And what's important to remember too is a real estate investment group is only as good as the company managing it. And if you're being managed by a bad company and they're not getting good tenants in there and there's a high turnover, unfortunately, there's nothing you can really do because you are part of that company and part of that group, and you don't really have a say in who they're bringing in or what strategies they're using in getting tenants or whatever. So you're really at the mercy of that company when it comes to a real estate investment group. So that's something you should consider as well before getting involved in something like that. But for many people who don't want the hassle of being a tenant and they don't want something as passive as a real estate investment trust, which we'll talk about in a second, this isn't really a bad option. But there's definitely more money to be made if you're a direct owner of real estate. Okay, now the fourth real estate investment strategy is a real estate limited partnership. This is basically like a real estate investment group, but with an exit strategy. Essentially what you're doing with this is you're actually financing the construction of a building or of an apartment building or any piece of real estate. It doesn't have to be multifamily, it could be anything. But basically how that works is a property manager serves as a general partner, and then outside investors finance the project as limited partners. At that point, after the building is constructed, investors may receive cash payments as a return on investment. So if that property is generating income, that income may be shared to the investors. But the lion's share of the income comes when that property is eventually sold, and then the investors take a profit because they were the ones who financed that project. The only downside to this is if that piece of real estate does not sell for what's expected, or if they have a hard time selling it, you might run into trouble with that there. But basically with this, you're essentially financing the construction of a piece of real estate. And then number 5 is a real estate investment trust, and also under this is a real estate mutual fund. They're so similar, I kind of tied them in together here. But this is basically real estate as a publicly traded investment. This is where a trust is formed to use money from investors to buy, operate, and sell income-generating properties. REITs are traded on major stock exchanges. It's just like investing in a stock. And then REITs must pay out 90% of taxable profits in the form of dividends to investors. So it's almost identical to a dividend stock, but the underlying investment is actually based on real estate. So this would be the lowest risk way to get involved with real estate as an investor, but it also will have the lowest possible yield because it's so low risk. REITs often represent non-residential properties, so a lot of them actually represent shopping malls. You'll also see commercial office buildings as well as healthcare facilities are common. That's what's represented under a REIT. And then a real estate mutual fund is essentially a diversified pool of these REITs. And then the last thing I wanted to do here is I kind of drew a line here to demonstrate like what the risk is of each one of these, what the potential income is from these, as well as the liquidity. And by liquidity, I mean how easily could you get rid of that investment if you had to. So first of all, direct ownership falls all the way on the left here. There's the highest possible return on investment, the highest possible cash flow from that investment. There's the highest risk associated with that investment because you're responsible for making those mortgage payments. And this has the lowest liquidity because it can be extremely difficult to sell a piece of real estate, especially in a bad market. Then pretty much real estate investment groups and real estate limited partnerships, they fall kind of in the same place here. They're kind of in the middle here. And then all the way on the right side here, we have real estate investment trusts and real estate mutual funds. These are highly liquid investments because they're traded on public exchanges. It's very easy to unload that investment. There's very low risk associated with these when you compare them to the other two here, or the other three. And also there's the lowest potential return on investment because they're such a low risk investment. But anyways, guys, that's pretty much real estate investing for beginners. This is like the most common ways people get involved with real estate. And based on your risk tolerance, you may pick one of these over the other. Personally, I have not invested in any real estate yet, but I do want to invest in real estate in the near future. And what I plan on doing is the direct ownership method, because personally I'm kind of handy. I know how to fix stuff up, so it wouldn't be a problem for me to have to go fix stuff or have to fix toilets or whatever it is. I can do basic plumbing, electrical work, things like that. So for me, it wouldn't be such an issue to have to go out there and be fixing those properties myself. But for other people, if you don't want to do that, there's definitely other options out there. And a lot of people don't realize that you can invest in real estate without actually owning the property. So that's why I kind of wanted to make this video to explain the different ways that people commonly invest in real estate. And there are other ways people invest in real estate as well. I just kind of wanted to make this as the most common ways people invest in real estate. Well, that's pretty much all I got for this video, guys. If you enjoyed it, please drop me a like on this video and feel free to drop me a comment with any feedback on this, as well as any other topics for future videos. And if you guys are new to the channel, please consider subscribing to be notified of any future uploads. And as always, I thank you guys for watching this video.